Hey everybody, Marty Mazzari here. It's the 5th of July, 2024. Hope you all had a great 4th of July. This is your weekly video update where we talk a little bit about the economy, a little bit about markets, and a little bit about anything else that I think is presently pertinent. In front of you is the graph of our PWA index, as we call it. We like to call it our general conditions index. When we're below the zero line, to us, that means that recession risks are higher than we're comfortable with. And therefore, as money managers, we need to accommodate for that in our portfolio allocation. You can see we've been in this zone or this below zero area ever since the late summer of 2022. Almost came out of it on 3 different occasions. Negative 23.91 is where we read right now. Doesn't mean markets are going to collapse tomorrow. It does mean, again, that recession odds are too high for comfort. And when we look at how equities, for example, in the US are presently priced, and I know we've spent a lot of time on this the last months, valuations are historically high. If we were to have a recession, even your garden variety recession, and you look at where earnings tend to go during recession, and you look at where valuation multiples tend to go, we are way out over our skis, so to speak. The market is pricing in earnings growth rates that today's macro environment, even without a recession, quite frankly, really can't justify from any semblance of empirical evidence, if you will. So this is just a market that is precariously positioned right here. In no way, shape, or form does it mean that it's going to roll over tomorrow. It does suggest that before this is all said and done, as this cycle finally plays itself out, that odds of something significant to the downside for equities are highly likely, or not small, let's say. But we'll come back to that here in a few minutes. Let's just get to kind of the overall economic setup, and just with a few bullet points, and then we'll move on. So the Institute for Supply Management survey results for June came out this week, and services, which had been holding up pretty well, have actually drop below 50. And below 50 is in contraction territory. And as you can see here, seldom do we get both of these below 50 without a recession following thereafter. It happened here in the early 2000s as the market was bottoming here in March of 2003. So we did get a dip there. And then the next time we dipped was right before the Great Recession, right, where we had them both in negative territory, and didn't happen again until the brief recession that was saved with 10 or 11 trillion of total fiscal and monetary stimulus. So the recession that we thought was going to be a doozy didn't get to happen. Got there briefly in 2022 during that 30% drawdown in stocks, and just briefly here recently, and then we're here again in 2024. So not a good sign, not a good look for the economic prospects going forward. The June jobs numbers came out this morning, and for that, I'll just read from my own narrative this morning. In fact, I'll pull it over so you can read it with me. So actually the number for June surprised to the upside. It came in on the establishment survey of 206,000 versus 190,000 estimate. However, the past 2 months were revised lower by a not small 111,000. Also, private sector jobs came in notably below expectations. They were 136,000. 160,000 were actually estimated. So the boost came entirely from government jobs, state and local primarily, up 70,000. Also, negatively speaking, and supporting our go-forward economic view, temporary employment actually plunged, lost 46,000 jobs. The unemployment rate rose to 4.1, which I think probably got the market's attention early this morning, although we did get a pop higher in the labor force participation rate. So that actually is a result of higher supply as opposed to lack of demand for labor. Average hourly earnings and average work week came in right at expectations. Sum it all up, look at the revisions lower, look at inflation coming off the boil, at least in the benchmark or headline indices, and I think we are looking at a September rate cut. And this is the kind of data that has equity and fixed income market implications in the short run, which I'll talk about here in a second when I give you our current equity market narrative. Also in my notes here, Eric Basmajian, analyst, macro guy. Heavy job losses continue to be reported in temporary health services. 3-month average, 30,000. This last month it was 46. The trucking sector is also consistently shedding jobs. And he accurately points out that when you get trucking and temporary employment shedding jobs, typically it ends up in recession, essentially is what he's saying here. Early movers in the labor market cycle. So we'll see. Again, that's still our base case before this is all said and done. And with regard to the ISMs, day before yesterday, I put this note in here. When the services were released, the June Services Index comports with our current go-forward view, recession likely beginning in the next 6 to 12 months, with inflation abating along the way. From the report, the decrease in the composite index in June is a result of notably lower business activity, a contraction in new orders for the second time since May 2020, and continued contraction in employment. Survey respondents report that in general, business is flat to lower, although inflation is easing. Some commodities have significantly higher costs. Panelists indicate that slower supply delivery performance is due primarily to transportation challenges, not increases in demand. Now, I do need to point out, though, in stark contrast, S&P Global does their own Purchasing Managers Index, and for the services sector, it was actually pretty positive. Growth momentum improved in the service sector in June, with firms seeing sharper increases in both business activity and new orders. So go figure. You have the ISMs really dropping, and you have the S&P Global's US PMI showing improvement. Now, obviously, the two survey different subsets of service providers. I'm sure they don't ask exactly the same question. From what I understand, the ISM captures a lot more respondents. And I will say that most analysts and economists seem to put much more weight on the ISM survey. It's been around longer, has more of a track record, and so forth. Nevertheless, though, these are questions that are legitimately asked to service sector providers in the same month. So again, quite the contrast. Again, you know the direction that we're leaning currently. Other data support that, but we do need to be open-minded and take it all in. Now back to the labor market. Let's just take a look at job openings data. That came out this week as well, and actually they came in higher than expected. We actually saw a pop for the first time in a while in job openings. So here's that. Job openings unexpectedly increased in May. So you can see just a slight pop back above 8 million. And when we look at the details, though, and these job openings are like a month behind, so you can see these are May numbers. But you can see in May, we had quite the pop in government job openings. And what did we get? We got a 70,000 job pop in government employment. But you can see private openings stayed about the same. But when we get into the weeds in the private sector, this is very interesting to me because you know the hot sectors and where everybody's been spending money is on travel and leisure, right? Well, hotels and restaurants, you can see job openings have plunged there. Retail trade overall, you can see that job openings have plunged. Interesting that we had job openings increase in manufacturing because actually in today's jobs number, it reflected 8,000 jobs lost in the manufacturing space. So little contradictory data there. Real estate and rental leasing, you can see job openings plunging there as well. So obviously on balance, what we're seeing here does not speak well about the go-forward state of the economy. And then just to kind of punctuate that point here is the U.S. Economic Surprise Index. Now you can see it just sideways or a little tick up. That would be today's better than expected jobs number. And I'm doing air quotes if you could see me here. But notice how low the economic surprise index has gotten. And folks, this is actual data coming out much worse than what economists had previously anticipated. And we are back to 2022 lows, and that was when we had that bear market where stocks peak to trough went down about 30%. And then just to update you, last week I showed you the overall container index and the Shanghai to LA index costs, and we were like right down in here just a week ago. You can see that continues to spiral higher. So while we're in an environment where inflation is coming off the boil, there's some pockets here that we're seeing inflation really ramp up. So going to be interesting. I do think we're going to see a Fed cut in September. And that's what the market is discounting right here. There is going to be a July meeting. It could happen there. That's doubtful to me, but it could. But I think what they'll be doing is setting the stage for September either then or in August when they don't have a meeting. The Jackson Hole Fed Symposium or the Jackson Hole meeting that they do, which has been historic in terms of Fed policy and changing policy and stimulating markets and that sort of thing. It's something that is going to be widely watched, and Jerome Powell's words are going to be intently focused on. So my guess is that if they don't tee it up in July, they'll tee it up in August, because we really think the data is going to continue to weaken. It'll be interesting to see, though, some of the inflation prints and how they're going to come out. They're probably going to weaken as well, despite the things that I'm showing you here. Okay, so let's just quickly look at markets. But before we get to the charts, I'm going to pull over our internal narrative. Once a month, I score was our equity market conditions index. We have 9 inputs, and minus 44 is not good. It's an oscillator. The best it could be is plus 100. The worst is negative 100. So that just says equity market conditions are not favorable for thoughtful, long-term patient investors. Let's put it that way. So what I like to do here is show what the averages did for the month prior. So in June, the S&P cap-weighted index was actually up 3.5%, up 14.48% year to date. Now, by the way, folks, over 40% of that, as I understand, is NVIDIA. NVIDIA literally accounts for 40% of the year-to-date gain in the S&P. Top 10 stocks are like 80%. Folks, this is the kind of breadth that is just screaming warning alarms to the market. That's just really bad breadth. It's not a signal of a healthy market, to put it mildly. The equal weight index, all of the same 500 stocks, but equally weighted, was actually down in June, and on the year is up just 4.07%. The NASDAQ 100 up 17%. Get this, the NASDAQ 100 equal weight, all the same 100 stocks, is only up 4.92% year to date. Russell 2000 index down on the month, 1%. Year to date, up just 1%, 2,000 smaller companies in the U.S. The equal weight index for the same 2,000 stocks, minus 2% for the month, minus 4% year to date. The Dow was up 1% on the month in June. The Dow was only up 3.8% year to date. If you equal weight the Dow, it's just 30 stocks. It's only up 0.25% in June, and just up 2.75% for the year to date. Okay, so some of my narrative. U.S. equities, the cap-weighted indices in particular, produced positive results in June, which jives with last month's commentary per below. Wow, at the same time, the underlying character continues to reflect dangerously abysmal breadth. I talk about those equal weight averages. So this is what I said last month. Ironically, while my stated concern ultimately leads to consequently lower equity prices, along the way to a harder than priced in landing, a notable rally in equities, maybe it's your classic blow off tops, is very much on the cards as the economy/inflation cools. So here I am showing you a pretty bearish fundamental picture, if not very bearish, and then saying stocks are probably going to rally anyway. So here's that bottom line. The likely equity market transition for the no soft landing scenario sees stocks flat to down as long as inflation remains elevated. So if inflation stays sticky, stocks don't really have any upside, in my view, consequently or sustainably, let's say. But then stocks rally as the economy and thus inflation cools. So that's this rally, and we're seeing it right now. Then stocks finally roll over when recession becomes a reality, and then a fundamentally sound buying opportunity presents itself, but you got to be patient right here. Now, the two things that showed improvement in June are big, really big in my view, and I'll show you the charts here in a second. And that's the US dollar went from neutral to positive for stocks, meaning we think the dollar has downside. And interest rates also, we thought, had downside on June 30th. And I'll show you just the last few days and what's happened there. Sentiment is horrible, meaning it's crazy bullish right now. Those are the makings of correction. So we could still very well get a short-term correction, although these are tailwinds if we're right about the dollar and interest rates. In terms of longer-term stuff, valuation, sector leadership, economic conditions, the technical trends and the breadth are all really ugly. Fiscal policy, we're just going to call that neutral right here. So those 9 inputs on balance are negative, but the stuff that could impact stocks in the short term, that really the market's trading on, things like the dollar and interest rates, those are bullish for the short term. But again, sentiment is very negative. The technicals are negative. So you want to be cautious, I think, here, even in the short term. Could we see, a 5-10% correction in the third quarter, which typically is not a good quarter for stocks? Unequivocally, we could. And again, the technicals and the sentiment are telling us that we should plan on that. But these could be effective offsets to that correction scenario. Again, all short-term stuff. We get into next year, and I think it's going to be pretty obvious where things are going. And I think that that's where we get to that point where we finally get that last leg that we're looking for. If our indicators and if what we think of the macro plays out the way we think it will going forward. Okay, so as for the technicals, S&P 500 daily chart, folks, those of you who've been with me for a long time should be expecting this market to roll over. But again, I'll say it for the third or fourth time, the dollar and yields look like we could push up above here. But right now, you've got a rising wedge pattern, you've got long divergences, you even have very short-term divergences as well, and you have a market that is really overbought on the relative strength index. I think the weekly chart is even more ominous. You've got rising wedge, bearish divergences, and typically overbought weekly charts tend to resolve with somewhat of a correction. Only got about a 6% correction in April, but we're right back there in that territory with even a bearish divergence there. So again, doesn't mean we're going to get a correction this time if the dollar and the yields continue to accommodate stocks, but the technicals are kind of pointing in that direction. As much, if not more so, for the NASDAQ 100 index. Here we are, all-time highs. Here we are, bearish divergences. Here we are, overbought. As for the dollar, that analysis that we did that said the dollar was bullish for stocks, meaning bearish dollar, bullish stocks, that analysis was done literally right there, and you can see what the dollar has done ever since then. And stocks have gone up ever since then. And right here is where we were looking at the 10-year yield, and you can see what it's done. It's gone down as well. Again, so those two things are very bullish for stocks, and those drops are consistent with what the data has been of late. Again, we said we thought the data would continue to weaken, and that's what's happening. And along the way to a hard landing, along the way to recession, you've got to cross soft landing territory where the Fed starts getting accommodative, and that's where we think the market could, continue to melt a little higher. We don't think there's huge upside right here. The downside risk is much greater than that. I'm about halfway through Grant Williams' latest podcast, and I'll no doubt take some notes from that for the log, so maybe I'll talk about that next time. But Jem Karzan with Kai Volatility is one of the, if not the foremost expert on what's going on in the derivative space with systematic investing and how that impacts markets. So we've spent quite a bit of time over the last couple of years talking about that, me illustrating for you options dealers positioning and how it can provide support for the market or resistance for the market. Right now, it's providing nothing but support. He makes that case. Really smart guy. He says our story about secular inflation, populism, and everything going forward, and what that fundamentally means for the market the next few years. He thinks it's going to be a lost decade for U.S. equities. That's our view after we get through whatever's left in this particular cycle, and I'm talking about the next decade. And but he does make the case that while the flows are what they are, while volatility is priced where it is, the positioning and volatility where it is right now, that it's going to be tough for this market to roll over hard, say, anytime over the next 3 to 12 months or so. But somewhere along in there, these things finally wear themselves out, positioning gets too far on one side, and that's when things begin to crack. His view is that ultimately these kinds of scenarios, this positioning and derivatives and the systematic scenario about where flows are going is very, very supportive of the market. And he thinks it continues to be for now, although the risk is still very high. But he thinks it's going to be tough, in the next 3 months, 6 months, maybe even 12 months for the market to crack. We think if we get a recession, it's going to crack. But ultimately, he makes the case that the fundamentals will ultimately win. And the longer this goes and the higher it goes, the harder it falls on the other end. That's been my experience over the 40 years that I've done this. And that's what keeps us confident that we're doing the right things and hedging portfolios. We're actually having a pretty good year to date. We're outperforming all of the equal weight indices, and most of them notably. We're not outperforming the cap weight indices. We're not heavily invested in U.S. tech and NVIDIA and that sort of thing. We have some exposure, of course, but not enough to keep track with what's going on in those cap weighted indices, nor do we want to. That's a mountain you don't want to climb right here with the storm warnings that are out there that we're seeing. But anyway, aside from that, it's still an environment that we could do okay in, but we want to be, I think, more concerned with doing okay if and when the market cracks. Now, I'll close here, and I have to say this each time. If our view of general conditions actually rises to where stock levels are, then suddenly stock levels aren't going to be out over their skis, and we can take on more risk at that point. But so either that has to happen, or stocks need to come somewhere a lot closer to where today's fundamentals dictate that they should be. So folks, thank you for staying with me that long. I appreciate it. I hope this information is useful to you. Clients, it's really just us always giving you the explanation as to why you're seeing the action, the movements, the hedging in your portfolios. It's because of our view of the whole global risk-reward setup as we sit here today. Have a wonderful weekend. I'll talk to you next week. Bye-bye.